Recession fears, inflation worries, and a hawkish US Fed have sent equities into a bear market and bond yields higher. We think US core inflation has probably peaked, and our sentiment indicator says that equity markets are extremely oversold. This should help markets to stabilise and possibly start to recover over the second half of 2022. Hi, I'm Andrew Pease, and I'm the Global Head of Investment Strategy for Russell Investments. Welcome to the third quarter update of our 2022 Global Market Outlook. It's been a tough first half of the year with global equities down by around 20% and the global government bond benchmark losing 9%. Markets have faced a laundry list of concerns. These include new pandemic lockdowns in China, the China economic slowdown, the Russia-Ukraine war, surging inflation, and central bank tightening. One small positive is that these issues are now at least well understood by markets. At the beginning of the year, it was unclear how far inflation would surge and how aggressively central banks would respond. There was little expectation that Russia would launch a full-scale invasion of Ukraine. The war has now happened. Core inflation looks to be peaking in the United States at least, and markets are pricing relatively aggressive tightening paths for most central banks. Our composite sentiment index, which measures investor sentiment for the S&P 500 using a range of technical, positioning, and survey indicators, is deeply oversold. This provides some reassurance that markets have accounted for the bad news so far and could recover if inflation and growth turn out better than currently feared. Of course, it's still possible that investors will panic and reach a sell everything capitulation point. We saw this in March 2020 during the pandemic sell-off. The lesson from previous market corrections, however, is that periods of panic can provide the best opportunities for longer-term investors. The main uncertainty is the outlook for the US economy. The pace and magnitude of tightening by the US Federal Reserve creates the risk of a recession by the second half of 2023. A deep recession could trigger a larger equity bear market, but we think a slowdown or mild recession are the two more likely outcomes. Household and business balance sheets in the United States are in good shape, and these should protect against a more severe downturn. The upside risk for the US economy and markets comes from the possibility that core inflation has peaked. This, combined with some softening in the labour market, could allow the Fed to become less hawkish in the second half of the year. The bottom line is that investors are worried about rising inflation, slowing growth, and the potential for an aggressive Fed to cause a severe recession. We think core inflation can trend lower over the remainder of the year, but the key question is by how much. A sustained move lower would ease fears around excessive Fed tightening and a deep recession. Until this becomes clear, however, markets are likely to remain volatile. Let's turn to our asset class preferences. There has been nowhere for investors to hide this year, with global equities in a bear market and bond yields rising. Our cycle, value, and sentiment investment decision-making process, however, cautions against becoming too pessimistic. Sentiment is extremely oversold and at levels last reached during the pandemic-related market panic of March 2020. Our valuation methodology scores US government bonds as cheap. It's hard to describe US equities as cheap even after the declines this year, but at a forward price-to-earnings multiple of about 16 times, the US market is getting close to fair value. Europe, the United Kingdom, and emerging markets offer better value relative to the United States. The main challenge comes from uncertainty around the cycle outlook. Aggressive central bank tightening and the threat of higher energy prices from the Russia-Ukraine war mean a recession in the United States next year is possible. Deeply oversold investor sentiment combined with peak market expectations for Fed hawkishness could be the catalyst for an equity market recovery, particularly if it seems likely core inflation has peaked in the United States. It's an appealing scenario, but may take some time to eventuate with the Fed still aggressively raising interest rates. The US dollar has made strong gains this year. It has benefited from Fed hawkishness and the dollar's safe haven appeal during times of market stress. The euro, yen, and sterling are now significantly undervalued on a longer-term basis. The argument for dollar weakness in the second half of the year is similar to the case for becoming positive on equities and bonds. Inflation pressures subside and the Fed becomes less hawkish. A weaker dollar would support the performance of markets outside the United States, particularly emerging markets. For now, we're broadly neutral in our asset allocation and recommend that investors stay at their longer-term strategic benchmarks. Deeply oversold sentiment suggests that investors have already accounted for a lot of the bad news. Negative sentiment can be a good contrarian indicator and a signal to become more positive. For now, though, we're waiting for clearer signs on the cycle outlook, particularly around the extent of Fed tightening and whether the US economy is headed for a hard or a soft landing. Thanks for watching, stay safe, and we'll talk again soon.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.